Happy holidays, everyone. I'm sure most of you are aware of the Farmer's Almanac. They're predicting a winter that will be colder than normal, with above normal precipitation and snow in our area. So hopefully they're half right with the precipitation, because we all know we could use that as farmers. So my name's Doug Benjamin. I'm the bank president here in Spencer. I'm here with our guest speakers, Jim Higgins and Brandon Zimmerman with Campbell, Higgins and Mummert, a local CPA firm in Spencer, Iowa. Jim will be our main presenter today, and Brandon will be here to help take questions throughout the chat and provide any support needed. A few housekeeping items before we start the program today. So I want to thank all of you for joining our third of 3 webinar series covering various tax changes and how to prepare for your tax appointment with your tax preparer. Over the years, we've had several different webinars and in-person meetings to help educate the communities we serve. We are fortunate to have some great customer relationships and appreciate the opportunity to leverage them to share their various areas of expertise. We're excited to bring you our series today on taxes for farming operations. The previous seminars covered taxes for businesses and taxes for individuals, if you want to go back and listen to those recordings. Today's live webinar is being recorded and will be shared after today's presentation, along with some helpful tips for you to reference. All participants have been muted, and we invite you to use our Q&A chat to enter any questions or comments throughout the webinar. We'll answer the questions during the presentation and also at the end. So without any more information to share with you, I'm going to go ahead and introduce our presenter today. Jim Higgins is an accounting graduate of the University of Northern Iowa and is the president and CEO of Campbell, Higgins and Mummert. He has been for the past 25 years. He grew up on a farm around Galva, Iowa, which introduced him to the love of farming and a strong work ethic. Jim expresses the importance and value of volunteering, which has led him to volunteering for multiple organizations. He has served for the YMCA, Spencer Community School Foundation, Spencer Hospital Foundation, and several church boards. In addition, he served and continues to serve on multiple advisory committees and assisted with many projects that allow him to give back and stay connected with his community. When Jim isn't working very hard, he is probably out in his woodworking shop building something. So, Jim, that's what I got. If you want to take it from here.
I will, Doug, and I just want to make sure as I start, you can see my PowerPoint screen.
Yeah, okay. You're all good.
Good deal. Well, thank you to Northwest Bank for hosting this opportunity for all of us to learn. Thank you for the participants for joining and jumping on today and spending an hour of your day with me. We're happy to be able to share some planning ideas, both federal and state, and just some planning ideas that relate to farmers. During my presentation today, I'm going to ask you a couple polling questions. Really appreciate your feedback, and then we'll have a couple stops along the way for questions. So please chat your questions in. So we'll get started today with a polling question. So the very first question I have for you, and I need your help with an answer here, is as you think about retirement, what is most concerning? And my choices I listed is, will my finances be enough? Will I be healthy during retirement? Will I be able to keep busy? Or who will take care of me during retirement? These are some of the questions that I get from clients as I visit with them about retirement, or some of the concerns that they have. So I'm interested to see the replies. And then once I get the replies, I'll speak a little bit to that topic. One of the ones I receive most often as you're answering this is item C, which is, how am I going to keep busy during my retirement, is something that comes up a lot. So interesting, yeah, 59%, will my finances be enough? And interesting, we're going to talk about that. Will I be healthy? That's great. So thank you for your input. So the very next item, these are the things that I'm going to talk about in some small way today. I'm going to talk about retirement. What does it look like? I'm going to talk about selected retirement tools that you have available to you. I'm going to talk a little bit about tax planning and income tax rates. I'm going to talk a little about depreciation, Section 179 expense, bonus depreciation, terms you're very familiar with. I'm going to talk a little bit about taxation of land easement payments. We've seen a lot of activity with pipeline activity through Iowa being contemplated. And then I'm going to talk about a few Iowa issues that are in the news currently. So I'm going to begin by talking about farming in general. You know, farming is a very capital intensive business, as we all know. Quite often when a farmer comes to see me in a situation or as we near retirement, we're talking about a very valuable equipment fleet that we need to sell or transfer to the next generation. We're quite often talking about millions of dollars of deferred income that's been carried over from years prior. And we start to talk about how do we fund that vision and our lifestyle during retirement? Are we diversified? You know, what types of retirement income sources do we have? Many times we're talking about how do we transition the business to the next generation? You know, we have farming children, we have non-farming children. How do we balance that? What's fair? You know, a discussion I get into quite often is $1 million of life insurance for non-farm children equivalent to $1 million of equipment for my farm children? So those are the types of things that we get into and discuss, and they're tricky. As I point out in the very last bullet point, in agriculture, specifically in farming, a lot of times there's not a turnkey moment in farming. In other words, that retirement or that transition of those assets happens over time. It takes time to make that transition happen. Okay, so when I talk with farmers, very oftentimes I hear one of two things. You know, retirement is an opportunity for me to do the things that I've put off or the things that I've always wanted to do. You know, I've always wanted to golf more. This is an opportunity for me to do that. I've always wanted to travel more. This is an opportunity for do that. Or I hear the reverse often as well. And when I think about retirement, it's really an uncertain time for me. I don't know what that looks like. It's a little fearful for me because I don't have woodworking interest, as an example, is something that I love. I don't have that interest. So I hear both sides. So the most important point I want to make for those of us that plan for your retirement or for that phase out period, I call it, from active farming to retirement, we need time. You know, we need to know who your team is. We need to work with your attorney, with your banker, your investment advisor, your life insurance agent. There's many potential other professionals that we're going to work with during that transition. And some of the tools I'm going to talk about a little bit today, I'm going to talk about retirement plans. I don't want to confuse that with retirement. Retirement plans is a tool in our toolbox that can help us transition from active farming to being fully retired. Also, I want to talk about entities. You know, some of you are familiar or have done it. Maybe on the call today, you've created an entity for a purpose of transitioning or transferring some assets, most notably land, to the next generation. You know, maybe you've used an entity in that planning. I'm going to talk a little bit about tax brackets. And then once again, the most important thing we need is time in terms of years to transition you out of active farming. When we think of retirement plan, many of my farmers communicate the very first bulleted point to me. They basically look at farmland rental as their primary source of retirement income. And we're going to look at that later and how the Iowa Department of Revenue looks at that now with the tax law change for 23. So one of the things I try to do with my farmers is really try hard to get them to diversify their sources of income at retirement. And one of the things I want to talk about is a story I had with a client and demonstrate the point of this. So I had a farmer that was contemplating retirement about 10 years ago, come and see me. He's in his middle 50s. He and his wife had a couple children. Typical story in some respects. Their children were not farming. They wanted to keep the farmland for their primary source of retirement income, but they wanted to figure out how are we able to get out of farming when we've got all this carryover grain and we've got this valuable equipment fleet. So we use that very first bulleted point there as a tool. We use a defined benefit plan. We used a cash balance plan. That's a way for us to put significant amount of money into a retirement plan. So in this case, we put about $200,000 a year for 5 years, 4 years, I can't recall exactly, into a defined benefit plan. So we got a deduction on our tax return for putting that money in there. And I should clarify, this particular farmer was just a sole proprietor farmer, owned the land individually, the equipment fleet, everything was just in his individual name. So we took significant deductions for those contributions to retirement. And then since then, he's experienced the market increase of that account over time. Okay. I've also listed some retirement plans right under that. I've titled them deferred contribution plans. And I think all of us may be more familiar with these types of plans. Individual retirement accounts, 401k plans, simple plans, and SEP plans. So when we look at those types of retirement accounts on the screen, it's very confusing in the names and they all work a little bit differently. But in general, I want you to think of and take back to your planning team, is this a tool we can use? We get a deduction today and it's income when it comes out. So a simple example of my farmer I was telling the story about, we took big deductions going in over a 4 or 5 year period of time. And someday when that money comes out, it's going to be taxable to that farmer as ordinary income. Okay, it's going to be ordinary income. We're going to learn later that that source of income under current Iowa law is not going to be taxable. So that's a benefit that just came about. That's not a benefit we knew about when we did this plan. So there are negatives to owning all farmland only, and there are negatives to having only a retirement plan. So what I like to demonstrate, or what the point I want to make today, it's nice to be diversified. You know, wouldn't it be nice to have a little bit of both? So my farmer I was telling the story about 10 years ago, you know, he's pretty happy today. He's got his farmland rental income, his farm's paid for. He's 65 years old. Now he's got this IRA is what it is. So he's got an IRA that he's got a pretty substantial amount of money in there. So he's got the luxury of taking annual sums out of his IRA to meet the financial needs of his lifestyle. And then he's got the luxury of the farmland and Social Security in his case now. So he has, again, diversity is important. Okay, the next slide is it's time for any questions that you might have. Does anyone have any questions out there that we might need to answer? I see one question. What is the main constraint you encounter working with farm clients in their retirement? You know, I'm going to answer that. Basically, the main constraint I work with is what I talked about on this previous slide is, you know, farmers are a little bit uncertain about what they want to do and how they can get through the taxes and so forth. They just see that as a big mountain that they maybe not they have a hard time overcoming. That's the biggest constraint that I encounter. Okay, no additional questions. I'm going to move on to the second polling question. What is frustrating about our current income tax system? I pay too much. It's too complicated. It changes too much. It's too political. I'm really interested in your answer here. As a professional that deals with taxes every day, you know, I come down on B and D. You know, it's way too political. It's way too complicated. We're managing things through the tax system that really shouldn't be managed through the tax system. I see that all the time. And I know there's a lot of frustration about the tax system, so I'm curious what the answer is here. Interesting. So it's about a tie. It's too complicated and I pay too much. Thank you for your input. So when we say we pay too much, the next screen, I kind of set us up for that. I anticipated that we might answer that. So what we're looking at on this screen is, I'm going to get out of my answers here. What we're looking at on this screen is the married marginal tax brackets for a married couple from 1973. So 1973 was a long time ago, almost 50 years. So if we look at that, I've highlighted the 25% bracket. So first of all, the bracket started at 14%. That was the lowest, and it ends at 70%. And this is just a federal bracket. So on top of that was the state of Iowa. So if we had a $100,000 W-2 income today, that would be equivalent to basically a $15,000 wage, if you will, right in this bracket right here, $15,000 wage back in 1973. Well, today, that $100,000 is in the 12% bracket. Back in 1973, we didn't even have a 12% bracket. We started at something higher than that. So quite often I make the comment to my clients, historically, we're in a really low income tax environment historically. And this slide, demonstrates that. I also want to tell a story about this slide. My business partner, or business colleague, I should say, told me a story one time about how his dad sold beans for $10 or $11 an acre, a bushel, back in 1973. The price was so good, he was able to take a wagon load of beans, which were estimating to be 250 bushels, and he went out and bought a pickup. I don't know if the pickup was new or used, but think about that. If we wanted to buy a pickup today, how many bushels would it take? 3,000, 4,000, even with $14 beans. Pretty significant blip in the map back in 1973. The next slide I have, this is the federal marginal married couples bracket for 2022. I've bolded $340,000 of taxable income. So a married couple can have taxable income of $340,000 before they pay tax at 32%. So in other words, they pay tax at 10%, 12%, 22%, or 24%. So that's a pretty significant amount of income. Now, some of you, especially being farmers, you guys are very keen to the tax rates and how the system works. This is only the income tax portion of what you're paying. So if we take 24% and we add a Social Security tax rate on top of that of 15.3%, and then we add the state of Iowa tax rate on top of that, we're approaching 50%, and you're all well aware of that. But the income tax component of that is low historically. Okay, what is tax planning? Is my next screen, and what do we do in tax planning, and what is it? Tax planning is a really important time for us. I often say to my clients, the most good I feel like that I can do for you is not during tax prep time, it's during the planning season, the off season, if you will. It's a time where we can discuss current and future tax related issues, transitioning your business, retirement, whatever that discussion may be. We have a lot of tools in our toolbox to assist us. I've listed a few of them. I've listed depreciation. You're well aware of how depreciation works. I've listed tax brackets and averaging, shifting income from year to year, charitable planning. I find that farmers are very charitable, especially when times are good on the farm. Maybe gifting to the next generation is something we discussed during tax planning. Election out of the installment sale treatment for deferred grain contracts. You're all familiar with deferred grain contracts of deferring the receipt of that income, deferring the tax on that from when you sell it. So a scenario might be that you sell the grain in November, you take payment in January, a deferred payment contract. When I get new clients in the farming world, I'm surprised at how many clients don't know of a strategy here. That's why I've bolded this. The tax law does allow us to treat a deferred grain contract that we're going to receive in January of 23, in my hypothetical here. It does allow us to pull that income back and tax that in 2022. And it's really simple. We really get the contract amount and we report it as income in 2022. Then when we get to 2023, we have a deduction for basis in that grain contract. So in other words, you're all well aware how this works. When that grain is sold in 2023, if you're a member of a co-op, it's going to appear on that 1099. So from that 1099, we deduct from that as an expense the amount that we pulled back and taxed in the prior year. So that's a tool available to us that I often see that people don't utilize. It's a great tool to allow us to use up tax brackets to a level that makes sense financially, or to a level that we want to get to. In other words, quite often with my farm clients, I'm pulling income from a latter year, 2023 in this case. I'm pulling those to the current year because it makes sense for that farmer to do that. And then, as I talked about earlier, I like diversification. Retirement plans is a way to diversify your income at retirement, something for you to talk about with your team and consider. Okay, the next screen, you guys could probably give it to me and teach me, all of you on the phone or on our call today, our webinar. I'll get it right. So depreciation, when I was at UNI, we learned that that was the systematic allocation of an asset's cost over its useful life. That's what we learned. Well, not so much in farming. You know, farming, we tend to look at that more as it's a deduction. We've had a good year. Let's go buy something. We can write that off. And you're right. In 2022, pretty much anything we buy in farming, we can write off. Equipment, tile, a building, bins, all those common things that you buy are eligible for a write-off, either bonus depreciation, which is still 100% for 2022. And I want to point out it starts to reduce by 20% a year under current law. There's been some talk about that being extended, but right now, this is what we have to go with. And then 179, we can write off on both federal and state, $1.8 million for 22. And then if you have gross purchases that reach the $2.7 million level, I rarely see that, it starts to phase out. We start to get less 179 available, okay? I want to point out, I get this question quite a bit. Like-kind exchange is still available for real estate. You can still do a like-kind exchange for real estate. And then the like-kind exchange for personal property, I want to visit about that a little bit. This was a dramatic change for me as a CPA that's been in public accounting for about a little over 30 years. For most of my life, when a piece of equipment was traded, the basis of that piece of equipment was zero, the old piece. And then we paid what we call boot for the new piece. We simply added the boot to a depreciation schedule. We wrote it off. We depreciated it over time. Well, back in December of 2017, we had a tax law sign that said, hey, we can no longer do a like-kind exchange of equipment, which is what that was. Personal property is the technical term. So basically now with equipment, we have to show the trade value as income, as if we sold that, a sale or exchange of that piece of property. And then we get to add that trade value to the boot we paid, and we get to depreciate a bigger number. So we get to depreciate the retail cost, if you will, of that piece of equipment. So from an SE standpoint, from a Social Security standpoint, that's a savings for us. Because I think, as you all know, the sale of that equipment is not subject to SE. the purchase of the equipment reduces SE, okay, in general, if we're a sole proprietor. So I know there'll be some questions here on that, but that's all I was planning to cover with depreciation. Okay, moving on to a topic that has been pretty common for me in 2022 is land easement payments. And I understand there's another pipeline contemplating traveling through Iowa and would affect our counties in Northwest Iowa that came to my attention just a couple days ago. So generally, for those of you that did get paid for your pipeline, they paid you, there was 3 components to that. They had a permanent component, a temporary component, and a crop damage component. The permanent component is really a sale of land potentially. The way that works, if you have land, and let's talk about 5 acres here. If you have 5 acres and the basis of that 5 acres is $1,000 per acre, you've got a basis of $5,000. If the permanent portion of that land easement payment is $10,000, now we've got a payment that exceeds our basis. We have a long-term capital gain in excess of our basis, taxed as a long-term capital gain. Okay. If that payment is less than your basis, then we just reduce the basis. And in essence, what we're doing is we're deferring that gain, right? Because we got less basis in that land. The temporary portion of that, the way I like to think of it is when the pipeline is being installed, someone is going to come in and rent some of our property to install that line. Okay, so that's just rental income as I understand it. It'll be reported on a 1099 miss. And then the crop damage, I think we all understand. Potentially they're going through your property or through your CRP acres, installing that line. So we're getting paid for that damage. I'm not an expert on CRP, but I know that you got to be careful if you have a pipeline going through your CRP. They maybe have some timing issues of when you can go through that CRP property. Okay, we're going to stop for questions. I see there's a couple questions out there. Questions I have is, how will interest rates affect the price of farmland? Great question. You know, farmland values today, I think any of us on the call probably 15 years ago would have never thought or dreamed that farmland values would get to 10,000 an acre or let alone 15 or higher. I think of interest rates and the commodity price as 2 variables that really have a pretty good effect on the price of farmland. There's a lot of other variables. You know, we've got outside interest. You know, maybe you as a farmer, you really see this piece of property as key to your operation, so you're going to go out and buy that. But I think generally what we'll see, and I think we've seen it a little bit already locally, we're going to see the interest rates creep into that decision. In other words, I was aware of 2 parcels that have sold in Northwest Iowa recently, where the professional thought they were worth 13 to 15,000 or something of that nature, and they sold more in the range of 11. So, you know, maybe we've seen some of that creep in. And when will current farmland values change or go up and down? You know, I think that's I don't know. I mean, no one does, but I think farmland values will hang in there at a higher level than we're accustomed to for the next year, with the commodity prices still being good. Interest rates are creeping up. It may eat into that a little bit, in my opinion. We're going to see some one-offs. You know, you're going to see a 25,000. It's going to be a one-off. I think we'll still see those. But yeah, if we're buying farmland today, we really got to plan how are we going to pay for that. Okay. Now I'm going to switch to some Iowa issues. Some Iowa issues have really been top of mind for all of us. I think, you know, back in what we're looking here. Let me see what we're looking at here. The screen we're looking at is the current Iowa individual tax bracket for 2022, and we can see that top bracket is 8.53%. So, on the first $1,743, we're going to pay a rate. On 3,400 to 6,900, we're going to pay a different rate. So once our income gets over 78,000, we're going to pay that 8.53% rate. So Iowa gets a lot of pub for, being a really high income tax state. We're at the top of the chart when it comes to rates. But one of the things that's not talked about there in that rate is the deduction for federal income taxes paid. I'm sure I could be wrong here, but I don't recall another state in my career that really allowed a deduction for federal income taxes paid. So that can be a significant benefit, is deducting that federal income tax. It brings down that effective rate. So on the very next slide, what we're seeing here is we're seeing the Iowa income tax bracket for 2023, 2024, 2025, and 6. So as we can see, the current law says we're going to have a gradual decrease in our overall income tax brackets. We have fewer brackets. In other words, 0 to 6,000 is a bracket or a layer or a category. And then we have 6,001 to 30,000, and then 30,001 to 75, and then 75 and over. And notice the bracket we're looking at is for a single individual. We also just have a single bracket and a married filing joint bracket going forward. So as I've said here, we just double the single bracket for the married. So Iowa theoretically has come up with something simpler. So we've lowered the overall rates, eventually getting to a flat tax rate in 2026. So when we look at the next slide, what I've attempted to show on these next 3 slides is the effect of that loss of that federal tax deduction. So if we take 2022 in this very first column, and we assume somebody had 50,000 of income, and we're deducting $4,244 as federal tax, we're going to pay an Iowa tax of $2,200. The very next column, we're showing that same income in 23, but we're not going to be allowed to deduct that federal tax. Now we're actually going to pay more tax. Our tax rates, our tax that we're paying is actually going to go up because of the loss of the federal tax deduction. So once we get out to 2026, we're going to pay something lower at our flat tax rate of 3.9%. Okay, so we move on to the next slide. It's the same thing, but we have a different income level. So now we have an income level of 100,000. Well, the same answer. We can see that we're going to pay a little more tax in 23 potentially, right? And then we can say we're going down to that 3.9% in 2026. And I think all of you know this, but it's worth mentioning. These rates and these laws are in effect until, they're not, until Congress decides to change them. And then the next level is if we have 400,000 of income, we're going to pay Iowa tax of 22,000 in 22, 23,000 in 23, and then it drops down to 15,000 in 2026. So a nice reduction in 2026. So moving on to a topic that's really been in the news this summer, this past summer and this fall, is when we look at retirement and we look at what Iowa has done. So if you're a retired farmer, the question we have is a portion of your income excludable from Iowa income tax starting in 23. That's the real question we have. So if we look at this, Governor Reynolds, she signed a bill back in March, House File 2317, that basically changed corporate rates and exempted from income a lot or most funds of retirement income. Okay. So the new law did contain a provision for farmland rental income for a retired farmer. So I'm going to go back to my thought that I said earlier. The Iowa legislature apparently recognizes that a lot of farmers see farmland rental as their retirement income. As a percentage, not a huge percentage has the retirement plan stuff that we talked about in terms of 401ks, simple plans, IRAs, etc. So they said, well, we recognize that Iowa farmers, they're investing in their farmland, makes perfect sense to me. It works for them. So we're going to make an exclusion. Well, how do we qualify for that? Well, the way we qualify for that is we have to be 55 years of age or older or disabled. We're no longer farming. The technical word is we're no longer materially participating. And then we farmed, if you will, for 10 years. So real simply, if we've got a sole proprietor farmer, he's 55 years of age or older, no longer farming, and he's cash renting, as I just stated below, or he's crop sharing, then I think it's clear that rental income will not be taxed in Iowa and will fall under the retirement plan exclusion. Okay. So we look at the next slide is where it gets a little messy and fuzzy, if you will. When we look at the next slide, we must have a written agreement in place for the rental of that land. Okay. I'm aware of a lot of farmers that don't have a written agreement in place, ironically enough. The rental income from a partnership, S Corp, trust, or estate does not qualify for this exclusion. So those flow-through entities, as we know right now, they don't qualify. Okay. So beginning in 2023, the new law is going to require us to say, if we have farmland rental income and we qualify, we're the farmer that's 55 and we've got a cash rent and we're no longer farming, do we want to exclude that from Iowa income tax? And the obvious answer is sure we do. But they're not going to let you exclude that and take a capital gain deduction on the sale of farmland. So you're going to have to pick between those. If you're a farmer that's going to sell your farmland and you're going to have a significant gain, you would have to weigh that against the exclusion of the farm rental income. So the thing I don't like is the bold is once the election is made, it may not be changed, is what it says. I use the word irrevocable, which is a word I don't like because life changes. So we are going to see a lot of changes and a lot of discussion in this area. It seems to me where I come down on this, it seems to me that rental income from an entity is not consistent with their overall thought of, recognizing that a lot of farmers have farmland rental income, and that does qualify for the exclusion if you hold it individually. So one of the discussion points I want to bring up is if you're a farmer and you own land individually and you rent that land off to an entity that operates your farm. So let's say you rent that land to a partnership, an S Corp, a C Corp, whatever. I suppose I don't know where Iowa is going to come down on that. But if we look at that, there's a possibility they may say, well, individually, an individual ownership of that land, you're really a landlord. You're really not a farmer. And so that rental income doesn't qualify. That appears to be where they're leaning, but I want to preface, I really don't know. I think that the very next slide I have, I think it's extremely important that you stay connected to your team on this topic, because I think there's a lot more to come. And like I say, currently there's a lot of unknowns surrounding this topic. So I have a question here I'll answer. Do you really mean rental income from a partnership, or do you mean rental income received into a partnership? Great question. So basically, if a husband and wife in farming own land and they have that in a partnership, let's say, and they're renting that to their S Corp operating entity, the way the law reads now, that income that you receive from that partnership, which is in essence rental income, or what we call a self-rental, would not qualify for this exclusion. That's the way I'm reading and understanding that today. Again, I think where I come down, I think that's inconsistent with the overall theme of the law. So we're going to have to wait and see what happens there. So next question. However, if a farm is in an irrevocable trust and I pass away, my kids get a step up cost basis. Absolutely right. You know, the irrevocable trust, the question I'm answering is not, it's a disregarded entity from a tax perspective. The revocable trust, I may have said irrevocable there, I apologize. The revocable trust is not regarded as an entity from a tax perspective. That's just you individually. So you're right, that does get a step up in basis. You're correct. And then what do you anticipate for tax law changes in 23 and beyond? You know, I can't prove this, but being in public accounting for 32 years, it seems like we're getting a lot more tax changes now than I ever recall 20 years ago. I don't know if that's just because I'm getting older, it's getting harder, but it seems like we're changing laws more and more. And I think the thing that makes me uncomfortable about the tax system is we're changing laws and a lot of people don't know we've changed them. You know, it's not publicized. We've got what I would call silent revenue raisers buried throughout the tax system. One of the tools that I used to use when I first started in public accounting, when a new law would come out or a new form, I would fill that out by hand. I would go through that and I would learn the form and I would look at every line and I would complete that by hand. Now remember, this is a long time ago. So today, I don't think I can do that with many forms. You know, I mean, you could still do that with some forms, but there's so many circular calculations and the complexity is just stupid, I say often. And I really feel that way. So, well, we are at the end of the material that I had planned on covering. So I'm on time, right on time. But if you have any additional questions, I would be happy to answer those. I like talking about taxes. So if there's any questions that you have, please throw those out there and I'll answer them.
Well, Jim, it doesn't look like we have any more questions in the queue. So I just want to thank you and appreciate all the great information you shared with us. Taxes are complicated for everybody, not just farmers. And so hopefully everyone took something away that they can use when they go to meet with their tax preparer. So again, thank you for joining us today. This is our final webinar of our three-part tax series. So please look for a follow-up from Northwest Bank in an email. The presentation is recorded and it'll be sent out to all the registrants. And also any material or unanswered questions will be sent out. And then there's a survey. If you could fill out the survey, we'd appreciate it. Your feedback will help us for future webinars and any areas that might interest you that you'd like us to cover if we can. So that concludes our webinar and have a great day.
Thank you, Doug. Thank you, participants.